Okay, is my screen visible? We start the
Yes.
today's market talk. Okay. Good prices and good news don't come together. This is what I wanted to highlight. That though the market is volatile and it does not provide that kind of comfort to the investors, but there is an opportunity which you can find to create portfolios in a staggered manner in this market. And in hindsight, we will observe that all corrections are like missed buying opportunities. The market setup, as I see, uh, Fed futures are indicating higher probability that the first rate cut will be by June 24 and a cumulative 100 basis point downward adjustment by end of 2024. So in the US, the core inflation and labor market have cooled down. Street is assuming end of rate hike cycle. Fed has, over a period of time, last nearly 2 years, done a cumulative rate hike of 525 basis points. And since then, Fed is in a pause mode. The retail inflation has come down to around 3.2%, which is very close to their intended level of 2%. The 3-month non-farm payroll addition has come down to the level prevailing before pandemic. But Fed doesn't want a repeat of 1970s when inflation bounced back, which forced them to raise rates all over again. So they are keeping the narrative this thing. But now in the December meeting, we will get some more better clarity, and people will watch the words of the Powell and all that. But people are 100% sure that there is no more rate hikes now. RBI is trying to nip the spurt in lending by increasing the risk weights on unsecured loans and on loans to NBFC. We saw that RBI raised the risk weights on banks on unsecured loans and loans to NBFC. So it wanted banks to set aside more capital, hike loan rates, steps which will force NBFC, which will affect NBFC on both assets and liability side of the balance sheet. But banks will be basically affected only on the asset side as they have to set aside more capital. But NBFCs will have both effect. The major impact will be on digital lending fintechs, uh, which will have to get more disciplined as cost of borrowing increases. Even Bajaj Finance had warned that the small unsecured loans are seeing increased stress. Now, talking about Bajaj Finance, somebody had asked me this. Uh, Bajaj Finance, the ban on two lending products would affect customer acquisition. In October, they did a QIP of 8,800 crore, which led the stock to go above 8,000. But most of the recently raised capital would go towards maintaining new risk weights against lending rather than growth. The new digital EMI card customers, which were around 19 customers, because 19% of the new customers acquired by Bajaj Finance, so that part will be affected. 40% of their loans book is unsecured lending. Hence, they have to raise their capital adequacy ratio by around 200 to 250 basis points. The other point is price to book is 6.32 times even now. So next year earnings of FY25 earnings is supposed to become 5, but it is expensive. But the other point is the ROE, PAT growth is higher than the others. We saw a spate of IPOs in the Indian market and the massive oversubscription. This was basically because the promoters left some value on the table for investors, and there was no surprise that the issues were oversubscribed. Moment there is some value, issues will get oversubscribed. And I'm very sure even if Tata Tech was priced 25% higher, it would have still got good subscription because they still left a lot of value. And there is a lot of money sitting with mutual funds which they have to deploy, which is coming to them through SIPs. And in an expensive market, the reasonably priced IPOs with bulk deployment of money where they get into anchor book, etc., is very attractive. Now, what I wanted to highlight here is convenience as a theme will create some big profit pools going ahead. We underestimate or underappreciate the monetizable value of convenience of home delivery that consumers are now getting used to. This is in reference to the basic home delivery of food and other groceries and medicines and other models. Now, Zomato did 65 crore orders last year. So if it charges a platform fees of even rupees 10 per order, which I don't think people will really have a problem with, because it is still better than getting food from outside for 10 bucks, then that is 650 crore straight away to profits, which is not there earlier. Other example of convenience is UPI. It provides convenience to merchants in terms of accepting payment. So it has increased their revenues and all those issues. Now, one of the IPOs, uh, which uh, okay, the other point is relative demand for luxury goods versus mass consumption goods is better. So we have seen housing inventory in South and Central Mumbai is at 15-year low. There is a sharp increase in gold imports. And one is the issue about demonstration effect, because people want to demonstrate to other people that they have money. So it is forcing people to borrow more through lending apps and NBFCs. And that is the reason why RBI is getting apprehensive about this unsecured lending. And the other point was that there is a disconnect between bank lending rates and the policy repo rates. I had highlighted it earlier that RBI raised repo rates by 250 basis points, but banks have not raised the rates, lending rates adequately, or it is below that 250 basis point. So the transmission of rates into the market is not taking place because of competition. So banks have actually reduced the spreads, thereby bringing down their lending rates in terms of saying that we have those digital infrastructure to understand the consumers and all those. Now the IPO which came this week was on Honasa Consumers, that is Mamaearth. And after the IPO, the price dipped to below 300, but then it came up with an impressive Q2 FY24 results as margins sprang a surprise. Now, what the company did is that they maintained a strong double-digit growth. EBITDA margins improved by 80 basis point year on year, 19 basis point Q on Q. They did a 21% year on year top line growth. EBITDA was up 53% year on year with margin at 8%. FY23 revenue was 1493 crore, but and this year's H1 revenue is only 960 crore. So they are expected to go up at least 25% in FY24 from FY23. The only problem is that it needs to spend higher on ads to acquire and retain customers. Ad expenses are 35% of revenues. And the other problem with them is that their single brand Mamaearth contributes about three-fourths of the business, that is 75% of the business. The remaining brands will take time to scale up. But the but the beauty and personal care business is now getting crowded with a lot of people coming up with those ethnic products and organic products and all those. Hence, the point is Honasa lacks a moat, so it can easily get disrupted. So be very careful in chasing this rally. Right now, everybody is very running after them. BSE has transformed from being a value stock to a growth stock. And such transformations are very rare and tend to get rewarded in a non-linear manner. And we have seen that BSE from 500 bucks has gone to 2000 plus in less than a year. The Q2 earnings of FY24 were very strong, and measures to revive volumes is showing success in equity derivative market. They have changed the charges on options from 1st November onwards. So earlier it used to be a value stock with high dividend and buyback used to be the narrative. Now because there is high earning growth, it has now become a growth stock. So they did a 53% growth in year-on-year revenue for Q2 FY24. Net profit tripled from 29 crore to 118 crore. Market share is 13% in derivatives. They are at 43 PE of FY25 earnings. So most of the good things are priced in. Cochin Shipyard is the other stock which was in news. Strong order book to support higher earning visibility. The PE is for FY25 earning at the present price is at 22 times. But the problem is that they had guided for 4,000 crore of revenues in FY24. And in the first half, if you see their uh, revenues, that is Q1 and Q2, they have just done 35% of revenue. Though, so the execution remains a challenge. Though they are claiming that they will get around 49 to 50 rupees EPS in FY25, so that makes them trading at around 20-25 times, which is decent. But EBITDA margins declined because of higher input cost. Though their order book is around 22,000 crore already, and there is expectations of a large order. So the point is, how much can they execute is a challenge now, as per these valuations, because you can't value them on order book. Now, talking about certain technicals, US 10-year yields, uh, this was the rising trend line. It had dipped below those rising trend line, was expected to go down and test the 38.2 retracement level, but it bounced back from there, and now it is testing this. So on Friday, it had bounced back to around 4.4. So let's see what happens. But these yields have to be monitored. It should come down to around 4.1 and 4.4 levels. One moment this December, in the December Fed meeting, the Powell's statement is slightly more dovish. Brent crude prices corrected. Now the base, if you see here, has been around $70. So it has now corrected and it's below its 200-day moving average, and that is a positive news for all the people, all the things which are using crude as a input, as a derivative. But the only problem is that the reason why the crude is correcting is because the expectations are is of lower economic growth in the next year. A dollar index again has come down below the 200 EMA and it is on the way down. So it should at least touch, it will test 100 and let's see what happens from there. And it is expected to go down because now it's in a bear market. Gold rose up to 2000 levels in this week, but at around these levels, it is better to book profits and then wait for lower levels. Lower levels, it takes support at around this 1800 levels, because this is also rising because the dollar was getting weakened, and dollar was getting weakened because I think the euro was getting, or the pound was getting strengthened. Now Dow Jones, if you see the weekly chart, this is the rising trend line. It took support there, and now it is above its 50 EMA, and it had four consecutive green weeks, and it is likely to head, in case this momentum continues, to its all-time high, maybe in a week or 2 weeks. So keep this in picture. S&P 500 again, it is now testing the declining trend line. Again, it has also had four strong weeks, and if it breaks through, then it will be a breakout for it. India's 10-year yield is correcting, and it's at around 7.2 now, and it's a declining trend line, so it is not breaking that. So yields are expected to now correct from here. The moment there is a clarity to the people on that there is no interest rate hikes in future. USD INR is a issue. It continues to keep going up. I think it had one of the highest closing now on Friday to 83.32. This may be due to FI selling and all those issues. Nifty 50 weekly chart. So if you see here, this is a channel in which it is moving, and it is a rising channel where it is making higher highs and higher lows. And it on weekly chart, if you see, it's very difficult for it to go below its 50 EMA. If it goes back below the 50 EMA, then it quickly bounces back, and now it is trading above the 20 EMA on the weekly charts. So it is expected to test once there is a clarity on political issues. Then it is expected to go up higher. And though it has also had four green weeks, positive weeks, based as similar to the US market, but the rise has not been as big as the US markets. If you see the Nifty 50 hourly chart, this is the 40 hourly moving average, exponential moving average. This is the support, and it took support there during this week on 22nd, and it is now there. And this level of 19,850 to 19,875 is where the resistance is there, where it tested it twice and turned back from there. Now the point is that this range is now becoming very narrow, and next week it will remain in this range, but then it is expected to break out either side now from this. But look at this 40-hour uh, exponential moving average for as the short-term support trend. The daily chart, if you see, same. It took support at 200 EMA in October, bounced back from there. Now it is facing resistance at these levels, which were the last high from where it had reversed last time in October. So it has gone there. It had a good rise, around 1,000 point rise, and now it is getting stuck there on a daily level and then correcting from there. So let's see what happens from here. This is the Nifty option chain. So if you see, there is a call writing at all levels, uh, 19,900, 20,000. And very interestingly, if you will see that Nifty uh, index corrected by 7 points on Friday, but the option premium for call writers changed by 40 points only on Friday. So because there is a the premiums are reducing because the premium on futures is also reducing. Similarly, now on the put side, there is a lot of put writing at 19,500, 700, 800. So that should provide decent support in case there is a dip. So these levels are there where people are writing put. So at least for this week, these should be the range 20,000 to 19,500. The put call ratio, you can see it's around 0.8, 0.82 or something. 17 lakh puts and 20 lakh calls have been written. Now, Reliance, so if you see Reliance, there's a declining trend line. It, it went below the 200-day moving average and it has bounced back from there. And now it has broken out from its declining trend line and up trading above the 50 EMA also. Hence, it is looking positive now. And so now these 200 EMA and 50 EMA should provide support to this, and one can go long on Reliance, and this should help the index. But what was happening last week was Reliance and HDFC Bank had become positive while the IT stocks had become negative. Now this is Bajaj Finance I was referring to. This one is now below the 200-day moving average now, and it has gone below that. So it's in a bear market, and it is going down with large volumes. Hence, one has to be careful. And I personally feel that it can go down to around 6,800 level at least, test that level, and then they will see what happens from there. It is presently looking weak because every news is negative for it. But the point is that it is pretty expensive stock. Nifty Bank, this is a weekly chart. Uh, it had a mixed kind of a week. It has taken support at 50 EMA on the weekly chart. So that was around 43,000, and it should trade above 43,000. I think that 43,000 should be a decent support for it. And if you see the daily chart, uh, it is now above the 200 EMA. But if you see on the daily chart, the 200 EMA is at around 43,300 and the 50 EMA is at around 43,900. So this is the range. Now it is stuck in this range, and it has been manipulated in this range by keep making alternative moves within ICICI Bank, HDFC Bank, and SBI. But it is stuck in this range, so it has to break this range for any decisive move either direction. This is HDFC Bank. Now it is clearly below the 200 EMA, which is at 1572, but it has broken above the 50 EMA, which is positive. It formed a base at around 1460 odd, and now it is on the upward path. So let's see up to what level it can go. And this is one of the reasons for the markets and the bank nifty to be positive in the last week. ICICI Bank, it has disappointed a lot of people. Now it went below the 200 EMA because you have to short ICICI Bank and then you go long on HDFC Bank just to keep the levels of Nifty Bank. Now, what is happening is it has broken about the 200 EMA. Maybe it is because of short covering on Friday. Otherwise, it was trading the whole last week. It was below the 200 EMA. It's a weak thing. So it should, for any strength, it has to go above 940 or 939 level. That is 50 EMA. Trade above that for some strength. Otherwise, it will just keep bouncing within this range and go below that or remain within this range. So there is no as such a clear trade on this. Now the PSU Bank index is showing sign of weakening. On a daily chart, it has come to its 50 EMA. So it is looking weak now, and it has had a sell-off in the last week, basically led by SBI. Now, if you see SBI in this declining channel, it is making lower highs and lower lows, and now it is up below its 200 EMA. And I'm very clear that the good support would come at around 500 level only for SBI. It is otherwise there is no momentum in this stock, and it will just keep remaining in this level and go down. Once it tests these levels from because from these levels only it had bounced back in March April this year. The stock which was strong was Union Bank, but again now along with the other PSU banks, it has declined over the last week and now has come to its 20 EMA. So we'll have to watch this level. If it breaks, then it will test these levels. But I just wanted to highlight this is the 26th October level of Union Bank, and it went to around 88 or 89 odd levels. So, which was a very attractive level to get into this. So, this is what I was telling. These opportunities come on those special days. Now, the stock which is strong in this market is SBI Life. Price has broken above the rectangle price trend continuation pattern. Now, if you see, and this pattern was on from July onwards, so it was in this range, and it has broken above that. So it can head to around 1600 or 1700 level in a month or so if this momentum continues. So this is a strong stock right now. The Nifty PSE index continues to be strong. It is now at its lifetime highs, and it continues to do well because stocks like NTPC are doing well. Now NTPC, if you see, uh, it had a falling channel breakout. So this channel was from October onwards was declining, and it was making lower lows, but then it had a breakout, and now it has gone above that. So it is looking to be heading to around 260, 270. And if you see the rise in volumes here, support this breakout for NTPC, though it was at very attractive level for very good time, 170 odd. That was the time when I had recommended to get into this stock. HL here again, like you see, it was in a range of around 1800 to 2050 to 75 for months now. 4 5 months it was there in this range, and this range bound movement was a kind of a rectangle. The price has broken out above this rectangle after this 5 6 months, and is likely to now head to very quickly to 2300 and 2450 levels now from here because there is some momentum to this stock and there is positive news also. Cochin Shipyard, I had discussed fundamentally. It had declined, but now it is going up with positive volumes. So now it is above the 20 EMA. So this is the stock which is expected to do well. So one can go long in this stock. IT index weekly chart. It it was doing well, but I think on Friday it declined because of TCS once the buyback date was over. Now it is still above this upper trend line. So till the time it is above trend line, it is above the upper trend line. It remains strong, and let's see from there. But the ER&D stocks will be in focus as the Tata Tech listing takes place. Auto index, this is one of the strongest index. So if you see from the lows of March, it has gone up to now to around 17,000 level, and it rose in the last week continuously, and all of the auto stocks are doing well, and it is in momentum with above trading clearly above the 20 EMA. So the stocks which are doing well, one of them is Ashok Leyland. It has, if you see, it has broken from falling trend line, and it had this long-term support line, upper trend line support also. So it has broken above that, and it is above its 50 EMA. It took support at around 200 EMA at these 165 odd levels, and it has broken above that. So it can head to around 190, 200 from here. The other stock is Hero Motocorp. It had a strong breakout with sharp increase in volumes. Uh, and if you see, I didn't draw it, but this is a classic cup and handle pattern which was formed. And if somebody can see inverted head and shoulder also, a pattern here, and it is headed to now around 3600 or 3800 levels from here, because the news is also positive in this stock, and this was beaten down for a long time. The BSE Midcap Index, it's trading above the all-time high, so it remains positive, though it had few red days, and some of the stocks are now getting sold out because they have become expensive. Similarly, the small cap index also, it is still in momentum, clearly above the 20 EMA, and it is getting stalled here because of the valuation. Now, I'll cover few stocks today, uh, which I find are very interesting stocks. The first stock is Aurobindo Pharma. Uh, the Q2 FY24 revenue grew 25.8% year on year and 5.4% Q on Q to 72,194 million, that is roughly 7,000 crores, driven by healthy performance across all key geographical segments, while H1 FY24 revenue grew 17.5% year on year to 1,40,699 million. So that means it's a good growth. Adjusted EBITDA for the quarter increased 67.7% year on year and 21.9% Q on Q, while for H1, adjusted EBITDA increased 41.8% year on year, primarily led by robust sales, and adjusted EBITDA margins improved around 486 basis points year on year and 293 basis points Q on Q to 19.5%, and the margin expanded for H1, that was Q and Q. Now this is for H1 first half year, it expanded by 311 basis points and to 18.2% levels due to low raw material cost and favorable product mix. PAT increased by 72.8% year on year and 30.6% Q on Q, and first half adjusted PAT increased 38.4% to 13,898 million, that is roughly around 13,889 crores. So PAT margins improved 296 basis points year on year and 210 basis point Q on Q. The H1 PAT margins expanded 149 basis points due to strong operating performance. I had brought out in the group that look for the ones which are supplying drugs, generic drugs to US. And here, this is the main reason the US revenue increased by 30.7% year on year on a constant currency basis. Volume gains, stable demand, and new product launches mainly drove the growth. The contribution of G Revlimid will start from Q3 FY24. G Revlimid is a drug which is used for cancer treatment. Uh, this treatment of cancer, serious conditions affecting blood cells and bone marrow. Uh, they will boost their US business growth, and Aurobindo Pharma will continue to invest in niche segments like injectables, inhalers, and transdermal patches. Now, if you see here, there is a cost. There is a now there is an improvement in revenues, though the revenues were declining in FY22, and that is was affected in the stock performance, and profits also declined. But now the things are improving, and they are expected to post a EBITDA margin of around 20% in FY25, and an EPS of around 60 rupees in FY25. So 60 rupees uh, EPS, uh, giving it a PE of around 18 to 20, you can easily trade at 1150 to 1200 for FY25's earning. And it has made a strategic partnership with Merck, which will continue to fuel growth beyond FY25 also. Uh, it is doing well in both formulations and API business. So if you see here, this is the segment-wise formulation: US, Europe, growth markets, ARV, antiretrovirals, and API business. These are constantly growing, and the segment-wise year-on-year growth is 26% for formulations, and for APIs it is around 20%. Overall revenue has improved by 25%, and this performance has now improved over the last few quarters, though it was declining in FY23. And revenue mix, if you see the region wise, uh, for formulations it is 84%, with majority coming from US and Europe, and 16% is now API, so which is basically their revenue mix. The key ratios. So if you see where they are expecting the EBITDA margins to improve to around 20% in FY25, the net profit margins will also improve now from single digit, which they had reached to 7 in FY23, to around 11 or 12%. ROEs will improve to 20%. ROCE will again be in 20% plus category. And EPS, as I said, this year is expected to 50 and next year is 60. So based on that EPS, I think the stock is already getting re-rated. So if you see, it has performed so beautifully from March onwards. It has nearly tripled from there now, and it has constantly traded above the 20 and 50 EMAs. And now it has, after these results and this positive outlook, it had a breakout, and now it is reached the 1000 odd levels. It crossed that 1000 levels, and it is trading above that. So this is a stock to be kept in mind and accumulated on all dips, because this segment is going to do well. It just missed our horizon. The other stock which I'm pretty positive about is IIFL Finance. I'll just cover it and you'll understand the reason why. It its competitive advantage lies in small ticket loans and in regions where banks are not effectively extended their lending services. It's a digital first company, partners with banks for balance sheet and partners with fintechs for leads and customer acquisition. Now I'll explain how it partners with banks for balance sheet also. It is a dominant in co-lending ecosystems, offers a key competitive advantage for IIFL to keep delivering a 25% AUM CAGR in the near to medium term. So it means is that co-lend means it is co-lending along with banks. So there is no all the lending is not coming on their balance sheet, but they are gaining for it. The lending goes to the or the risk goes to the balance sheet of the banks. The loan AUM CAGR is 25% over FY23 FY25. They are expecting to make a profit of around 25 billion, that is 2,500 crores by FY25 with a capital adequacy of 25%. They have 2,700 plus dedicated gold loan branches across 25 states and union territories, and it offers doorstep gold loans in 35 cities. It has 70% repeat customers, with MSME farmers being the key customer segment. These are basically bridge loans to conduct any activity. So the chances of defaults are very less on this because they are secure loans. Loans are operating in more than 10,000 pin codes, and 60% are in tier 3 and 4 markets. Supply chain finance, potential market size is rupees 14 trillion, that is 14 lakh crore. Banks are not keen on entering this segment as the cost of borrowing is prohibitive for MSME. Hence, uh, these guys come into picture, these NBFCs come into picture. The other existing players do not have the underwriting models for this segment. These guys have developed that model. So that is one source of revenue. The total addressable opportunity is huge in its core products of home loans, gold loans, MFI, LAP, that is loan against property, and digital business loans. So it covers all aspects of loans. So it has a wider field as compared to people like Muthoot Finance or Manapuram Finance or Bajaj Finance, which were traditional people for lending and all. This, along with expectations of sustained economic growth and improvement in credit penetration in the middle of the pyramid customer segment, firmly positions IIFL to deliver a healthy ROA and ROE over the medium term. So it has a total network of around 4,600 branches. I've moved around. I'm finding most of their new branches are regularly popping up. What happens with co-lending is that 40% of loans are off their books. Hence, it is good. You will see they are even lending to commercial real estate. Uh, they are doing paperless onboarding and servicing of customers in MFI loans and all these things. The latest RBI circular will have an impact of around 40 basis point on their CAR because their portion of unsecured loan lending is lesser as compared to others like SBI cards and Bajaj Finance and all that. As discussed, per capita income of the middle income customers improves, the credit penetration will also improve because those who will earn will also like to borrow more. They are now looking to raise funds not from capital market but through NCDs and CPs, which is cheaper. CPs is commercial papers. Now let's see their financials. Now, if you see here, FY23, they did interest income of around uh, 73,693 million. That is roughly 7,369 crores. Expenses. So net income improved by around 32%. Total income improved by around 30%. Operating expenses went up by around 41%, consisting of these things. Operating profit was up to around 22%. The provisions declined, and so the profit before tax improved, and PAT improved by around 35%. But there is a healthy improvement in PAT over the last 2 3 years now. So if you see here, this is the ROE is improving, and this is the total PAT for only first half. So if you see, it is expected to be much higher than what it was there profit in the this thing FY23. Asset quality is good, and provision coverage ratio is around 44%. They have GNPA of around 1.8%, which is better than most of the banks and other NBFCs. This is their AUM mix. So if you see home loan, gold loan, LAP, digital loans, microfinance, CRE, as I brought out, commercial real estate, capital market finance, so everything. This capital market finance is basically one of the aspects here is IPO funding. Their top 10 institutional shareholders is best of the institutions. Hence, so people would have gone through their books and then only invested money. This is their home loan business, which is doing. So if you see here, the home loan business is 33% and gold loan is 32%. So most of both these two are secured. Similarly, loan against property. It is these digital loans which are unsecured, and microfinance is also slightly secured only. So it is only this small part which is unsecured. So this business is growing, affordable housing finance business. The AUM is constantly improving, and yields are around 11%, which is very good. Home loan branches have improved, and GNPA has declined now. So that is good. That shows their resilience. The MFI loan again, it's growing. AUM is growing, and ROE is improving. ROA is around now 4.9%, which is good. Uh, HDFC Bank operates at around 2% ROA, so that way it is very good. MFI lending yields improved to now 24%, and asset quality is within control. GNP around 2%. Now, if you see here, uh, for FY23, yield on loans is 20%. The cost of funds is around 8.6, so spread is around 11%. And names are pretty good, 7.2%. Banks are operating at around 4% names. The profitability ratios are in 20% category. ROA is now above 3. Valuation wise, price to book is around, for FY23 is around 2. So it has come down, and I showed you Bajaj Finance is at 6 right now. So, but that is what I was saying, that there is a valuation comfort. EPS around 42, EPS growth is around 35%, P is around 15. Hence, this is a stock to be looked at. Actually, IIFL Finance, because of this latest RBI issues, it dipped to its 100 EMA and it took support there and bounced back. This is the place where actually I started buying this stock first at 50 EMA and then at 100 EMA, and let's see where it goes. But this is a good stock for long term. Now this is one very interesting stock, uh, Size Silk Kalamandir. This is launched in FY05, that is 2005. One of the largest apparel retailers in South India, offering products across ethnic wear, saris, and value fashion. Four popular brands: Kalamandir, Kanchivaram, Vara Mahalakshmi Silks, and Mandir, and KLM Fashion Mall, straddling multiple price points. So among them, the Mandir is the costliest. Saris may go up to 3.5 lakh to 4 lakh rupees, and KLM Fashion Mall is the cheapest, and you may get a sari for around 1,000 odd rupees also. The sari market in South India is pegged at 262 billion rupees, which is roughly 26,000 crores a year. And there is a migration to from unorganized to organized, which is taking place. It has a extremely concentrated cluster-based approach to expansion. I'll show you that. So it is not wasting money on all the, because opening a store, sari you can't do online selling. So people like to come and see and wear the sari and all those issues. So it has very concentrated approach to store expansion. Uh, it's a primarily a retail focused company, directly procures all of its products from master weavers for its saris and third party manufacturers for other products. They did an IPO recently, so that 560 crore they want to use it to expand its presence in Tamil Nadu via Vara Mahalakshmi silk products. because I'll show you their this thing product wise and how it is. So the first product was Kalamandir. First store was opened in Amirpet in Hyderabad uh, for basically affordability, brand equity, and all those issues. So contemporary saris targeting the middle class and upper middle class. Then they went into Vara Mahalakshmi, which is a slightly better product, established in 2012 with a store opened in Kanchipuram, Tamil Nadu, providing customers the famous Kanchipuram silk saris and other handloom and occasion wear saris under one roof. It offers authentic premium silk saris and each unit inculcates one of its kind. Then they went into their niche product, which is Mandir. This was established in 2011 with the first store opened in Banjara Hills, Hyderabad. See the location, right? The Mandir brand is a one-stop destination of ultra-premium designer high-end saris, including party wear, festive wear, occasional wear, saris, and langas, which can be customized as per the requirement of the customers. Lastly, they opened this KLM Fashion Malls, established in 2017 with first store opened in Amirpet, Hyderabad, providing value fashion catering to youth and masses with new age fashion choices at an affordable value for money price point. Variety of products is offered for each of the segment, including men's wear, women's wear, kids wear. They have two trademarks: Common Man Fashion Mall and a pocket-friendly mall for KLM Fashion Mall format stores to target the customer segment intended to capture through its value fashion product offering and increasing brand visibility. Now, if you see their profit and loss statement, this is in millions. So they are expected to improve it uh, very fast. So the margins are also expected to go up from around 15% now to 18%. And the PAT margins are expected to now get into double digits next year, with a PAT expected of around 269 crores here and 189 crores in FY25 and 114 crores in this year. And a EPS in FY25 is expected to be around 12.3 this thing. So if you 12 EPS, you give a 30 P, it can easily trade at 360. It's around 300 right now. Uh, this is the key ratios. So the presently as per the price, the P is around 23 or for FY25. Price to book, ROE is expected to improve, ROIC is expected to improve, ROCE is expected to improve. A revenue mix, if you see, uh, Kalaman, it is going up for Vara Mahalakshmi brand, and it's expected to go to 57%, and they are focusing on this. Other brands, they are just not that focused, but that is why they are trying to open this Vara Mahalakshmi shops in uh, Tamil Nadu. Now, this is the geographical locations breakup. So if you see, they are majorly in Telangana, Andhra Pradesh, Tamil Nadu, just four stores, Karnataka, nine, nothing in Kerala. So that will be one more issue. So what is there is they have roughly around 54 stores in 12 southern districts. Only 12 districts they are there, and they're expected to do 20 to 25% sales growth over the next 3 years with an ROE of around 15 to 20%. FY25 EPS, I told you, expected to be around 12. So you can expect it to reach 360 rupees. Sari market in South India is 26,000 crore, and if you see the revenue, it is only 5%. So of market share. So it is like a shark in the ocean. Uh, the 50% of sari sale in India is from southern India, so they are focusing on this part of the country. They presently have no presence in Kerala, and in Karnataka also it is only in Bangalore, and in Telangana major share is from Hyderabad only. It enjoys highest revenue per square feet because of concentrated approach, and it has got the lowest cost of retailing among its peers. Now this got recently listed uh, in September, I think, end, and from around 220 odd levels, it has gone to around now roughly 300 levels. So this is the stock to be bought on all dips. I finished. We'll take the questions now.